Okay, so today we're going to be looking here at Chapter 6. So Chapter 6 deals with cash, fraud, and internal controls. So as a reminder, we have looked at some internal control procedures way back in Chapter 1. In Chapter 1, we first saw things like the fraud triangle. We saw things talking about how companies are organized, and we might have even talked about some basic internal controls that we could use at that time. Here in this chapter, we're going to expand on that knowledge and kind of dig into a couple of key areas that deal with these items specifically. So moving right into chapter 6, this chapter is relatively short compared to some of the others, but some of the individual items take a little bit of time to get through. So we're going to try to cover this quickly so we have a good understanding before we come to class, and then we'll expand on some of these ideas in the classroom. So the first thing we've got to think about here is when we're talking about cash and we're talking about fraud, I think it's pretty easy to see that cash may walk out the door a little bit easier than other items. And we might be able to conceal that a little bit more easily in the absence of a solid system of internal controls. So when we're talking about internal controls, it's very important that we understand what we're actually trying to accomplish. So internal controls are primarily used for four things. The first, of course, is to protect the assets of the organization. So this may just be the cash of the organization. It could be anything else. It could be their inventory. It could be maybe computers or software, hardware, proprietary formulas, anything like that. Whatever the company has that they're using, of course, is what they are trying to protect. Second, we are trying to ensure reliable accounting. So essentially, what we're putting on our financial statements is correct. If we are not able to do that, if we're not able to ensure that those accounting records are accurate and are reliable, then we don't have a good system of internal controls. Next, of course, we want to uphold company policies and promote efficient operations. I throw these two together because they tend to work very closely together, because hopefully your company has developed policies that are efficient. If they have not, then it may be worth looking at, examining some of those policies and trying to streamline them so that you can have a more efficient operation. So when we're talking about internal controls, the story starts way back with Sarbanes-Oxley. So prior to Sarbanes-Oxley, essentially accounting firms policed themselves. It's an oversimplification perhaps, but it works for an introductory course to say such. The issue came, though, in the early 2000s, in the late 90s, when we started seeing several large accounting scandals pop up. At the time, we had Arthur Andersen, who was one of the largest accounting firms in the world then, auditing several companies, namely WorldCom and some others, who they were not really doing quality audits for. Well, when this happened, what all came out is that the auditors had been performing audits that didn't meet any real standards. Because of this, several frauds were missed. Large companies went bankrupt. We had all kinds of problems come out of this. So in response, Congress said, okay, if the accountants can't be trusted to police themselves anymore, we will police them. So they came out with the Sarbanes-Oxley Act. It has a couple of key features that are extremely important for us to note. The first is listed here. The Sarbanes-Oxley Act requires managers and auditors of public companies. Notice this is of public companies. So the small private institutions are not necessarily bound by SOX, but they may choose to implement the guidance found within SOX because it does tend to be fairly good guidance. So we are requiring not only the managers, but also the auditors of those public companies to document and certify the system of internal controls that is in place. So what we're saying here is not only do you have internal controls written down in some notebook somewhere filed away in HR or in some policy manual, but are those policies actually being implemented? It can read perfectly well as a solid system of internal controls on paper, but when we actually go test that system of internal controls, is it working properly. So both the managers of the company and the auditor will have to sign off on a report saying that that is the case. Secondly, this requires that managers document and assess, of course, the effectiveness of those internal controls and how they would impact financial reporting. So the way this looks for most public company audits is the auditors will come in and there will be a memo to the file for every single internal control, or at least the major internal controls that the company is relying on. So this could be, just a handful of internal controls for a really small company. This could be hundreds or thousands of memos for a very large company. So this definitely adds a significant amount of time to the audit work, but the idea here is it should lead to a more useful audit as we are getting better information. So you say, well, this all sounds great. How do I know what's going on? How do I know if my organization is set up in a good way? So where most companies look is to COSO. So COSO is the Committee of Sponsoring Organizations, and they provide 5 areas of internal control which add quality to accounting information. The first of these is the control environment, followed by risk assessment, control activities, information and communication, of course, and monitoring. So when we talk about the control environment, we're typically looking at a very high level area of the organization. So this might be the CEO, this might be the CFO, this is anyone up in that C-suite primarily is who we are looking at when we are talking about this level of the control environment. So it's a very important area. So whenever you hear people talk about the tone at the top, we tend to be talking about this control environment. So this tends to be the company structure, any ethics decisions and integrity, anything like that, typically getting decided at that very high level of management. Right below that, we've got risk assessment. Risk assessment essentially has 3 areas. We want to identify, analyze, and manage any factors relating to risk. So in this area, we're really trying to see what are the threats to the company, how can we deal with those. The next level, of course, deals with control activities. These are, of course, the policies and procedures the company has in place to help reduce any losses that the company may incur. The next area, of course, information and communication. This is where we're primarily dealing with the actual reporting of the information. So we've put everything together. We've got all of our policies from our control environment. We've identified any risks. And now it's time to tell people about this, about how this is all going to work. And so this is where we have to become good communicators, get good at writing, get good at speaking, telling people exactly what is happening here. Because if I simply give you an accounting report that's several hundred pages long, but I don't walk you through that, it's probably of limited use to you if you're not familiar with the accounting rules. So we want to make sure we're able to explain that to people who may or may not be extremely familiar with some of the accounting terminology. Next, of course, we've got monitoring. So with monitoring, this is simply a regular review of the effectiveness of internal controls. So this is where we simply essentially go back through the process. This leads us into essentially a circle where we begin this process again, and we go through and we now look once again at our control environment and assess, do we have good ethical leadership at the top? Do we have good decisions being made there? If we do, then let's go back and look at that risk assessment. So the idea here is this is not something you're ever done with. This is always something you're looking to improve on. So here with our internal control procedures, there are some basic principles we want to understand. The first item here is you must establish clear lines of responsibility. The reason for this is if something goes wrong or if something goes well, you need to know whose responsibility that was. So if something goes wrong, I need to know who I can go talk to figure out what happened. This isn't necessarily to assign blame, but we do have to realize that things need to get done, and if they're not getting done, we need to know why they weren't done on time. So the issue here is with these responsibilities, this allows us to go to the person and say, all right, what happened? Why was this not completed on time? Is it because they are simply not trained well enough? Maybe we haven't put in the time to train them to be efficient enough to be able to handle that amount of work. Maybe they were in charge of a group and 3 people called in sick for the last 2 days. So maybe they were really short-handed. Maybe there was any number of other items. Maybe the client sent them poor information. Maybe the client didn't call them back or didn't give them any information at all. Who knows why this didn't get done, but we've got to find that out. And if I don't have clear lines of responsibility, there's no way for me to adequately tell what happened so that I can hopefully prevent that from happening again. Next, we want to make sure we're maintaining adequate records. So in the rules or in the accounting world, we tend to say if it's not documented, it did not happen. So if you tell me that you went and you did this test and this audit, but there's no work paper identifying the date it was done, identifying the person who did it, there's no work paper showing me that the procedure was done at all, then when our organization gets sued for a poor audit perhaps, I have no defense, because the rule is if it's not documented, it did not happen. So we've got to make sure we're always maintaining exceptional records so that we're able to defend ourselves and support any conclusions that we draw. Next, of course, we want to insure assets and bond key employees. Insuring assets, I think everyone pretty much understands. Bonding key employees is something you may or may not have heard of prior to this course. This simply means we buy an insurance policy in case they steal from us or in case they commit some type of fraud against the company. That bonded policy will help prevent some of that loss. Of course, we want to separate record keeping from custody of assets. So if you're the one documenting who has all of the assets, then you shouldn't be the one in charge of those assets, right? We want to make sure that that is in a separate location with a separate person so that we don't allow somebody to very easily manipulate any of those records. Of course, you want to divide any responsibility for related transactions. We want to make sure we're getting dual approvals, perhaps. We want to make sure things along that line are happening. Of course, technological controls are exceptional and they are growing. This is things like passwords on computers, keypads on doors, anything like that. Of course, one issue with anything technological, particularly as we start moving things into like the cloud, is that those areas are vulnerable sometimes to external parties hacking into that information. So we've got to make sure we have very good technological controls and firewalls and security measures in place to help minimize the risk of that. Next, of course, we want regular and independent reviews to be done regarding all of this, but anything else in the company as well. So here, of course, establishing responsibilities, you really just want to make sure people know what they should be doing. Of course, it's best if these tasks are assigned to one person because then you can determine who is at fault. Once again, maintaining adequate records. This really is just some more information on all the items we just talked about a moment ago, but essentially this is what we were talking about a moment ago. So I'm really just going to flash these up here so you've got enough time to pause it if you want to look at these, but otherwise I'm really just going to continue for now. So hopefully you had a chance to pause the video if you wanted to look at any of those slides, but otherwise we will go ahead and continue on. So you say here, well, nothing really beats a paper and pencil. We like that idea. It can't be hacked into. It's much more difficult perhaps for somebody to steal. But the problem is anytime you're dealing with something, particularly for a large organization, it's not very practical in today's environment to be doing a lot of these calculations by hand. Most of these things are done either in something like Microsoft Excel, AlterYX, any number of other data software items. Some companies have specific data packages exactly built to their needs. So there's all kinds of technology that's creeping into the business world. And here's some of the reasons that we like this. This tends to reduce processing errors because if something is done repeatedly, I can design a macro in a matter of minutes, maybe to a couple of days if it's a very complex macro. But then once I've got that set up, I never have to worry about it going wrong because it's going to do the exact same thing in the exact same order every single time as long as the formatted data comes in properly. And I can design a macro to format everything too. So it really cuts down on any processing errors because once you have the format set, it runs perfectly every time. Of course, the problem with manual entry of stuff is, of course, as you work, you may become tired, you may become burnt out, anything like that, leading to careless errors. Maybe you forget to carry a number. Maybe you accidentally write a number down backwards or transpose numbers, or you write a debit down as a credit. All these things are normal human behavior, but we can eliminate a lot of this if we simply automate a lot of these functions. Now, another good thing here is once we've got all of this in an electronic format, it allows for much more extensive testing of those records, not only internally, but of course by those external auditors who come in at the end of the year. Now, the last one that I really want to focus on here is this idea of separation of duties. So separation of duties is perhaps the number one internal control that we will talk about in this course. So if you have heard nothing else, if you hear nothing else today, please remember that when we're talking about internal controls, your strongest internal control 9 times out of 10 is this idea of separation of duties. What this means is that, for example, if I have a gas station, so I have a clerk who runs the cash register for me. Should that person who runs the cash register ring up the sales, collect the cash, go to the bank, deposit the money, come back with the deposit slip, record the entry in the journal, post that, and then update my financial statements? What do you think? Would that be good to have the same person do all of those steps? Well, of course not. Because what stops that person if nobody comes in and balances their drawer, if nobody's checking receipt totals, making sure what should be in the drawer, anything like that, right? It's all on that one clerk, okay? What stops that clerk from simply taking $100 off the top every day and putting it in their pocket? Absolutely nothing, because they have total control of the situation. What should happen is at the end of the clerk's shift, they should balance their drawer. Ideally, you would then have a manager come in or another person come in and balance their drawer also, verifying the total. At that point, the cash should be passed to another party who will then drive to the bank, take the cash to the bank, deposit the cash. They will come back with a deposit slip that should be compared to the count that you had before they left. The deposit slip and the count should match up exactly. You'll then take the deposit slip, you'll record the journal entry recording the fact that the money has been deposited, but of course that will be done by a party that did not go to the bank. Now they will be then comparing the journal entry to the deposit slip to the count. This is what we want to see. The more you can separate these procedures amongst more people, the better likelihood you have that fraud is not occurring. Because originally, if this was only done with the clerk or done by the clerk, well, they're the only one that's ever going to know they've done anything. But if you've got to convince 3, 4, 5 people to go along with this, it gets much more difficult to do that. Of course, that does happen sometimes. This is what we call collusion, when multiple people work together to defraud an organization. But it is much more difficult to pull off than it is when you're simply working by yourself with very little oversight. So, limitations of internal controls, of course, 2 main ones. So we talked about the first one a little bit on the last slide where we talked about human error. So we said things like maybe you get tired, you accidentally make a mistake. Maybe you read this really complex regulation by the IRS or by FASB and you think you've applied it correctly, but you've actually misunderstood. So you had poor judgment come in and you treated this item totally wrong. It wasn't intentional, but it's still not correct. So maybe there was some confusion. Anything like that is what we're looking here under human error. Now, if you make a mistake, are you going to prison? Well, it depends really on how bad that mistake was. If somebody looks at this and says, all right, you should have probably known, then yeah, you might be going to prison. But if it's something where you really just made a mistake, right? You weren't intentionally changing something, you weren't trying to affect the outcome of the audit, you weren't trying to change the opinion fraudulently, anything like that, right? You made a mistake. Mistakes happen. Sometimes they're bad mistakes, but they happen. I'm not saying you won't lose your job, but you may be able to avoid going to prison if you really did make an honest mistake. But if you committed fraud, right, which is the intentional defeat of internal controls for personal gain, or the intentional deceit of another party for personal gain, then you are certainly looking at a fairly lengthy prison sentence, especially if this is an extensive fraud. So when we're talking about fraud, there are essentially three areas you've got to look at. Once again, we talked about this back in chapter 1. This is what we refer to as the fraud triangle. Here they call this the human fraud triple threat. I suppose that sounds better to the textbook in this chapter, but this is what we talked about previously as just the fraud triangle. It's got the three areas: opportunity, financial pressure, and rationalization. And of those three, of course, the one the company can limit the most is that first item, the opportunity. Because here's the deal. Financial pressure, we could alleviate some, right, if we paid our employees more, but most companies really can't afford to do that. They're barely getting by, especially in this current climate as they are. They can't really afford to be increasing wages. Now, rationalization, that's fully on the individual. So that is where the individual says, all right, they owe me, they don't pay me for overtime, they overwork me, I'm underpaid, whatever the case is, I've got medical bills or I need to pay my rent. Whatever the case is, this is the employee or the individual actually justifying the fraud to themselves. Because here's the deal. Even if you commit a perfect fraud and nobody ever finds out about whatever you've done, somebody still knows that the fraud has occurred. And that somebody, of course, is you. So at some point, you're going to have to look yourself in the mirror and be okay with the fact that what you did was not only immoral and unethical, but illegal, right? You're going to have to be able to live with that every day that you get up and you look yourself in the mirror. So there has to be this level of rationalization for the person to feel like they can do this. But the truth is, those last 2 points, financial pressure and rationalization, they don't actually matter if there is no opportunity. So even if you've got financial pressure, you've got bills, you've got medical bills, you've got rent, student loan debt, anything, right? Even if you've got that pressure, and even if you can justify it, I'm overworked, I'm underpaid, they don't appreciate me, right? Even if all of that is there, if there are extensive internal controls in place, you can't commit the fraud because the opportunity has been taken away from you. So what the company is going to focus on primarily is eliminating the opportunity for fraud to occur. So this is why we have passwords on computers and locks on doors and cameras over cash registers and things along those lines, right? Security systems, anything that you can think of is probably some type of internal control the company is using to help maintain the honesty not only of their employees, but their customers and everyone else. Right? We don't want our inventory just walking out the door. So what do? We put little tags on it that beep when you walk outside. We put scanners on items. We put cameras on aisles and over doorways. So we've got all kinds of ways that we work to reduce the opportunity of someone being able to commit this fraud. Now, the next thing that we've got to consider, of course, is cost benefit. So here's the deal. 9 times out of 10, if the cost is more than the benefit of this procedure, I'm not going to do the procedure, because here's the thing, all right, if we think about this. What if you had the ability to completely eliminate any theft from your store, right? You've got a small corner shop and there's a security system that you can purchase that will for sure eliminate the ability somehow that anyone could ever steal so much as a single piece of gum from your store. Right? I tell you the cost for that system is $10 million, right? Well, your whole store is probably only worth $100,000 or something. Okay, so even if somehow you could scrape together the money and buy this new equipment and this new security system that costs $10 million, it's probably not worth $10 million to protect $100,000, right? So we've got these issues where, yes, we could have a little bit better internal control, but if the cost is excessive, sometimes we have to live with the fact that, yeah, there is a way somebody could probably exploit us a little bit, but hopefully it's not so much that it drives the company under. So we've got that issue as well. Now, I will tell you, along with this, it's not exactly related to this, but it is a fairly interesting thing. Somewhere between approximately 5 and 10% of the cost of any item that you buy in a store is there because of fraud either being committed by the public or by the employees of the company. So companies realize their internal controls are not perfect and that people are going to get away with stealing things from time to time. So what they do is they actually increase the prices on all of their goods to help counteract some of that. So in the actual practicality of it, what this means is that if society as a whole quit doing these types of things, we might be able to actually see a little bit lower prices in our goods and services from these stores because we wouldn't have to worry about things walking off on their own. So it does affect you on a personal level as it affects the price of stuff that you buy every day. But these cost benefit analyses are often done, and sometimes we don't like the results. Now, in some cases, there are legal requirements to tell us we must do this or that. And in that case, it doesn't really matter if the cost is more than the perceived benefit. If the law says we have to have this internal control, well, we have to have this internal control. And so there are certain areas where this doesn't apply. But very often, if the cost is excessive, we will simply live with that small amount of risk. Now, the next area, we're really just looking at cash. I'm not going to spend a ton of time defining what cash is. I think we are all aware of cash. There are a couple of items that you may not think of when you think of cash, things like cashier's checks and things along those lines. But all in all, cash is cash, right? So coins, currency, anything like that is what we're talking about when we talk about cash. And it is often the case that cash is one of our most mobile assets. If something is going to suddenly disappear, it is much easier for cash to disappear from a drawer than it is for a large machine that is bolted to the ground to disappear. So we've got to have a little bit more strict control when it comes to cash. So the first thing we're going to look at here is handling cash. So the actual collection of cash, for example, should be separated from the record keeping. Now, a couple of years ago, there was a case in one of the surrounding towns, I truly can't remember where there was at one of the courthouses a person who was working at the front. And what was happening is the people were coming in and were trying to pay their tickets. Okay, so they got a speeding ticket. They got some other arbitrary ticket for some minor offense. Okay, so they've gotten a ticket. They come to the courthouse to actually pay that ticket off. Well, what was happening is if these people were paying cash, what the person collecting the cash was doing was taking the cash and then writing on their ticket that the ticket had been dismissed. So what just happened is she took the cash, dismissed the ticket. So when the city looks, they say, oh, okay, well, we shouldn't have received any cash on that ticket because it was dismissed. So they're not expecting any cash inflow, but she just got $200 or $300. She did this over and over and over and was able to collect an extremely large amount of cash, and she refused to ever take a sick day. So here's the deal. If you've got an employee who is religiously at work, they never miss, right? They are there every single day for years. They never take a vacation. They never go anywhere. They never do anything. They are always at work. You've got one of two options here, right? One, you got an exceptional employee who loves their job and is dedicated to helping the company succeed. Hopefully, that is what you've got. But the other is a situation akin to what we are talking about here. You've got somebody who may be committing some type of fraud, and they know that if they leave, the odds of them getting caught go through the roof. So here's what happened. The audit firm came in and noticed that for whatever reason, this courthouse had significantly less cash receipts, perhaps, than neighboring courthouses or courthouses of the same size, and they weren't really sure what was causing that. So they started asking around, and they found out that this lady who worked up front had been there every day for the last, say, 10 years and had not missed a shift ever. So what they did is they said, well, she seems like an exceptional worker. Maybe you should go send her on a vacation for about a month. Have the company pay for it. Tell her she can't come back for a month. And what we're going to do is we're going to track the cash receipts over that month compared to the prior months and compared to prior periods of similar timing in the prior years. We're going to see if there's a significant change in the amount of cash collected by the courthouse over this new period of time. So they send her off on her vacation and she leaves. By the time she comes back, what has been noticed is that as soon as she left, cash receipts went through the roof. And the reason, of course, for this is any tickets now being paid in cash were actually collected by the courthouse. They weren't going into her pocket. So when she comes back, she's met with two things. One, she's lost her job, and two, she's now being arrested on charges of fraud. So here's the deal. When you are dealing with cash, the person collecting the cash should never be the one recording the cash collection. They should collect the cash. Write down, right? Hey, I collected $500 from Jimmy. Then go to the next department and say, here is the cash that I collected from Jimmy. They will then record the transaction and adjust that customer's account. In this case, for whatever reason, there was a poor system of internal controls that was allowing the same person collecting the cash to write off a ticket. I'm sure the lady must have been there for years and years. Everyone thought she was very trustworthy. Everyone thought she would never do something like this. But something happened in her life, I would assume, that led her to make this choice. And so because of that, she had the opportunity. If there had been better systems of internal controls, it would not have mattered. She would not have been able to commit the fraud. So you've got to be very careful about this separation of duties that we see, particularly as it pertains to cash, because the person collecting the cash should not be the same person who is recording anything related to that payment. Now, the next thing, of course, is you don't want your cash sitting around in your business for months or years on end, right? Probably what you want to do is at the end of every day when you have your last sale made, you want to bag that up, and first thing in the morning, you want to drive over to the bank and deposit that, right? You want to get that cash into the bank as quickly as possible so that it is not available for someone to come in and take out of your register. So it is not available for one of your employees to take out. And of course, it is best if any cash disbursements are made by check, because this provides a paper trail that we can then follow through later if we need to. If we simply hand someone a $20 bill, there's no record of that. But if we write a check for $20, I can see check number 1275 was written for $20 on January the 5th, 2021, blah, blah, blah. Here's who it was made out to. Here's who signed off on the check. We have a lot better information to then go back later and say, well, what was this $20 for? Well, hopefully on that memo line, someone told us, right? And so we've got this better system that we can then figure out, well, was this a legitimate purchase or was this something fraudulent? So definitely, if you're making any cash disbursements, you want to try to do so by check. Now, as we talked about a minute ago, cash includes all kinds of stuff that may or may not be common to you. So currency, coins, and deposits and bank accounts, of course, perhaps the three most obvious items here. But of course, this could include other things, any checks written by customers, cashier checks, certified checks, and money orders. This also can include what are called cash equivalents. So if you look at a company's balance sheet, very often under that asset section, right at the top, you'll see current assets. That very top line is often not cash. It is often called cash and cash equivalents. These cash equivalents are short-term, highly liquid investments that can be converted to a known amount of cash very quickly and are close to the maturity date and therefore not sensitive to changes in price. So if we have this set up, right, cash and cash equivalents on the face of our balance sheet, typically what you will find is a note in the back of the financial statements that tells you, well, we have this much in currency, we have this much in short-term liquid investments, we have this much in this item and that item, and here's how we know. And so they'll show you that build out of exactly what is included in that line item. Now, a couple of ideas when we talk about managing cash. So the first is we want to plan cash receipts to meet cash payments when due and we want to keep the absolute minimum level of cash necessary to operate. So we've briefly talked about this first point prior in the semester. I believe it was in chapter 4 when we were looking at the discount terms. So we saw things like 2, 10, and 30, and we said at that point in time, the only 2 dates acceptable to actually pay that bill are the 10th day and the 30th day. And that is because we said, if you're giving me a 2% discount as long as I pay within 10 days, I have no incentive to pay within 4 days. I'll pay on the 10th day. And if you're not, then I have no incentive to pay on day 16. I'll pay on day 30, because the longer I can hold on to my cash, the better I am. So we want to try to do that, but we also want to make sure we're not holding a tremendous amount of cash that we're not going to be using in the immediate future. Because here's the deal. If I've got cash simply sitting in a checking account somewhere, I'm probably earning something like either exactly 0% interest on it or 0 point something percent interest on it. It's essentially earning my company nothing to leave cash sitting in checking. It gives me some peace of mind to know that if a bill comes out that I had forgotten about for some reason, then I can cover that. If my payroll comes up, then I can pay that. Of course, we do need some cash set aside in a checking account somewhere for us to operate, but we want the minimum amount, because if it's not sitting in a checking account somewhere, we can have that money invested elsewhere. We can have that money invested in buying new long-term equipment. We can have it invested in some type of security somewhere. Maybe we're buying bonds or stocks in other companies, but we can have that money actually working for us instead of simply sitting there in checking account earning us exactly nothing. So you want to try to keep the minimum amount of cash that you need to operate on hand, as it frees your cash up to do other things that are more valuable for your organization. Now, a couple of things you want to try to do. The first, of course, is to encourage collection of receivables. So this means perhaps tightening credit policies. So instead of giving people 60 days to pay, maybe we only give them 30 days to pay. Now, of course, there could be a downside to that policy. As you tighten your credit policies, people may be less likely to purchase your product or to buy from your organization. So every decision essentially has two sides. Now, you want to delay payment of liabilities, as we've talked about several times already, paying on the last available day. Now, once again, don't pay late, right? Don't delay payment to the point that you're late, right? If you've got 30 days, pay on day 30. Don't pay on day 32. Don't pay on day 38. Pay on day 30. You want to make sure you are paying timely, but there's no reason to pay early unless they give you a reason to do so, which typically would be a discount in the price. Next, we want to look and make sure we're only keeping the assets that are absolutely necessary to the operation of the organization. If I've got a lot of assets that aren't being useful, then I want to eliminate those assets and sell them. Then I can purchase something that is more useful to us. We want to make sure we're planning expenditures well, trying to look to the future, making sure we've got enough cash on hand to be able to meet any upcoming cash expenditures. And of course, if we've got excess cash, we want to be sure we are investing that either in the company or in other organizations to help generate a return for our shareholders. So here we see just a general graphic identifying the sales department, collecting the cash. So we've got the clerk rings up the sales on the register. They prepare some type of sheet at the end of their shift, identifying how much cash should be there. That should be paired with an envelope or with the cash in some way, identifying on the sheet we should have $408.16. Then in the envelope you should have $408.16. That will then move through to the cashier department, who will fill out a cash sheet, which will then be moved down through the preparation of any records or deposit slips, and then eventually a journal entry will be made. At the end of all of this procedure, of course, the supervisor will come in, review the cash sheets and the deposit slips, as well as any other supporting records, making sure everything ties down, and will then send a copy to the two departments that were previously involved in this so that they can sign off on it, saying it looks like everything went through as expected. So a good system of internal controls there. Here's the deal. If you've ever worked as a cashier anywhere, you probably know that at times your drawer will not balance. Okay, this can happen as a bank teller, this can happen as a cashier at a restaurant or a store. So if you've ever had any responsibility along those lines, regardless of how good you are, it's very likely, if you were there long enough, that at some point, at least once, your drawer was off. Okay? This doesn't mean you've done a terrible job or a terrible thing. It just means you're human, right? Every now and then we make mistakes. As long as it's not consistent, and as long as it's not huge errors, we can live with it, and we've got to deal with it in some way. So what we do is we deal with this account called cash over and short. In this case, we're going to look at an overage. So sometimes errors, of course, in making change for customers or refunding their money or whatever is happening, maybe you have had a very busy day, there hasn't been a break in hours, you just one customer after another. At some point, your mind slips for just a second and you hand somebody a 20 instead of a 10 or something small, right? But you've made a mistake. Somehow your drawer got out of order. You reached where the 10 was supposed to be and there was a 20 there and you didn't notice, right? Some kind of mistake has happened. Well, when that happens, we've got to figure out how to fix it. So in this case, we're actually dealing with the opposite situation. So there's too much cash in the drawer at the end of the shift. So for some reason, we gave somebody less money than we should have. So let's see here. If the cash register's record shows $550, so that is what should be in the drawer. But the count of cash in the register is actually $555. What does that journal entry look like? So here's the deal. You have to record cash for the amount that you actually have. Because cash is an asset, for it to be an asset, you have to actually have it. So for this situation, even though we should only have 550, the 555 will be recorded as the increase to cash with a debit. But because the register's record shows only 550, that means we only had sales revenue of the $550. So a debit to cash and a credit to sales. Now the difference, of course, that $5 difference is going to have to go somewhere. So you say, well, where on earth does that go? So when we are looking, we have to determine if we have more cash than expected or less cash than expected. So in this case, we had more cash than we expected. So what I'm going to do is credit the account cash over and short. So here's how this works. This account will have a credit when you are over the amount that you expect, and it will have a debit balance when you have an amount less than what you expect. So I want you to think of this similarly to how we think of gains and losses. A gain is similar, right? It is not a revenue, but it is similar to a revenue. And so a gain will have a credit balance. Well, if you have more cash than expected, that is similar to a gain as well. So if you have more cash than expected, this account will have a credit balance. But if you have less cash than expected, that is similar to a loss, which is similar but different from an expense. So if there is a loss, or if you have less money than is expected, then cash over and short will be treated with a debit balance. So we do see that here. Okay. Now, one quick note, we do want to make sure we understand this cash over and short account will appear on your income statement. So do keep that in mind. Okay. Now, in the next case, we see a shortage. So in this case, if the cash register's record shows we should have 625, but the amount of cash in the register is 621, then we are off by $4. So to deal with this, the journal entry we need is a debit to cash. Remember, you can only record cash for the amount you actually have in the drawer. So the 621 goes in as a debit to cash. The credit to sales is for the amount shown in the register's record because that is the amount of revenue we generated. So we will credit sales revenue for 625. Next, we've got to plug the difference somewhere. So we've got 621 in debits and 625 in credits. That means we're off by $4 and I need an extra $4 as a debit. So what I'm going to do is simply debit cash over and short for $4. Doing so balances out my entry and makes sure we have completed a correct journal entry for handling this shortage. Now, if we receive cash by mail, here's the procedure we should see. The first is that 2 people should be opening the mail at the same time. I should not have one person opening all of the mail on their own, because all they've got to say is, oh no, we never received the mail from customer letter A. All right, they said they mailed a check, but the post office must have lost it because we never got it, right? So you want to make sure at least 2 people are always opening the mail. You want to have the cashier deposit the cash in the bank, and then of course the record keeper will record the amount received in the accounting records. Now, when we're looking at cash payments, a couple of things we want to keep in mind. All payments should be made by check. That way we have a physical record showing where the cash went to. We want to limit access to checks except for those who have the authority to actually sign those checks. So that is our initial control of these cash payments. Now, of course, just as you live on a budget in your personal life, a company should live on a budget in their business life. So we want to make sure that our cash budget will include any projected cash receipts and disbursements. Now, a voucher system of control, the textbook talks about for a little bit, about a page, I think. I'm not too concerned that you understand exactly how a voucher system of control works. I just need you to essentially know these 2 points. So if you can just learn these 2 points, that'll be plenty for you to get any question right on the exam that I give you over a voucher system. So a voucher system establishes procedures to do 2 things. First, we want to verify, approve, and record liabilities for eventual cash payment. So we want to know what we owe and when we're going to owe it. And then once it actually comes time to pay this, we want to issue checks for payment of notice, verified, approved, and recorded liabilities. So we're paying for the items identified in step 1. What this means is if somebody shows up with a bill and says, hey, you owe our company $10,000, we don't just go inside and write a check for $10,000. We want to make sure that we were aware that we owed them $10,000 and that this isn't someone just coming up trying to get money. So we want to make sure we have some type of control system in place. Most companies will actually have a list of verified vendors. And if you are not on the list, you do not get paid. So it makes sure that we can limit how much we may be vulnerable to somebody just coming in saying, oh no, we did all this work for you across town. It cost us this much. Here's the bill, right? And they're talking to somebody who wasn't directly involved, but for whatever reason, they've got a checkbook for the company and they go ahead and write them a check because they don't want to make the vendor mad or they don't work for us again in the future. So it leads to all kinds of weird situations if you don't have some good system of control in place to actually deal with the payment of some of these bills. So here's a bunch of categories. This exhibit is, of course, in the textbook. It's exhibit 6.1. Feel free to look it over. I'm not going to have you label all of this or something crazy on the exam. So I wouldn't dwell on this, but if you do want to look at it, it is fine to do so. Next, we want to deal with this idea of petty cash. So petty cash is something that we deal with when we've got small incidental expenses in the office. For most companies, they will institute some type of voucher system of control or something very similar. We see how that could be quite time intensive, particularly if it's for something very small. So if somebody wants to throw a pizza party for the office, right, and the money's there, then maybe we should just be able to do that without having to go get 2 or 3 signatures and run it by the CEO, right? So what we do is we have something called petty cash. This can also be used for small things. If the plumber has to come, if an electrician has to come and make some quick repair, redo one line, fix a switch, something very small that isn't going to be very expensive. If somebody shows up and we've got to pay FedEx at the door, whatever the case is, if we've got some small cost that doesn't necessarily make sense to run up through all the chain of command, then we'll probably pay this with something called petty cash. So petty cash works like this. We've got a box sitting somewhere in the office perhaps, and we've got one person in charge of that box. And you say, well, why does it have to be one person? Well, if something happens and that box does not balance at the end of the period, I need to know who is responsible for it. So we want to make sure only one person has the key to this petty cash box. That way, if we balance, we know they've done a good job, and if they don't balance, we know that they are the one responsible. So here's how this works. When we establish a petty cash fund, we will simply debit petty cash and credit cash. This is simply a movement of cash between two categories. So cash is, of course, an asset. It sits on the balance sheet, has a debit normal balance. So by crediting cash, we are reducing the balance in that account. Petty cash is simply going to increase with a debit just like cash does. And so we see it going up here with a debit as well. So debit to petty cash, credit to cash will establish the petty cash fund. Now, during the period, some expenses came out of petty cash. So here's how this works. You want to make sure that if you are in charge of the petty cash box, that anytime you make a purchase, you have a receipt. You want that receipt to go into the petty cash box as soon as the cash comes out. So for example, the miscellaneous tile cleaning that we see on November the 27th for $46.50. I pay them for the $46.50. They should give me either a printed or a handwritten receipt, something signed off by the other company, showing me that this is an outside party's receipt. Here it is, right? We've got it. At that point, I'm going to put that receipt in the box. What I should have then is the $46.50 receipt as well as the remaining cash in the box. When I add those two items together, that should come out to $75. Because at any point in time, one of our major rules with petty cash is that the receipts in the box plus the remaining cash should always equal the total balance of the petty cash box. So in this case, if the petty cash box started with $75, I spent $46.50, I think that leaves $28.50 to be in the box. So hopefully that is what we see in that box at the end of the period, if that was our only expense. In this case, though, we had several other expenses. So we had some freight coming in, so that $15. We had the $5 for a customer's package that got delivered as a delivery expense, and we had some office supplies of $4.75. Now notice at this point, that is a total of $71.30. If we had a total of $75 in the box, that means there should be those four receipts totaling out to $71.30, as well as $3.70 in the box. That will let us see that, all right, we've got receipts for this, and we've got the remaining cash. That totals out to the full amount, so we've done everything properly. But if that's not the case, then we may have to deal with that in a moment. So first things first, we need to reimburse the petty cash fund. So here, cash payments will be reported and are used to make the journal entry to reimburse the fund. I want to point out a couple of things here. We're going to simply debit each of the expense and credit cash, but notice one of these. Okay, miscellaneous expense, $46.50. But notice the merchandise inventory for $15.05. What was that for? Okay, that was the transport of merchandise purchased. Remember, the cost of inventory is not just the purchase price. It is also including any cost necessary to get that delivered. So in this case, since we paid the shipping as the buyer, that must go into merchandise inventory, consistent with what we saw back in chapter 4. Now, the next row, delivery expense. Notice that was also for freight, but that was for the freight of something we sold. So we paid the shipping for a sale. So because we paid the shipping to deliver something to our customer, that is simply a delivery expense. And that is why one of those is being debited to merchandise inventory, the one where we actually purchased the inventory and had to pay the shipping, while the one where we paid the shipping for a sale made to a customer runs through delivery expense. And finally, office supplies expense of $4.75. Now, notice the credit here. The credit does not come out of petty cash. The credit simply comes out of cash, because what we're having to do is actually put that cash back into the petty cash fund. Well, there's not room in this journal entry for petty cash because we've got to identify what all of that money was spent on, and then we've got to pull the cash to go into petty cash from general cash. So that is why when you are reimbursing the petty cash fund, you will actually not see the petty cash account anywhere in that journal entry. Now, the next time you will see petty cash is if you decide to either increase or decrease the overall balance in that fund. So if you increase petty cash, what you will do is debit petty cash and credit cash. If you decrease cash, you will simply debit cash and credit petty cash. But notice the only two times you actually use petty cash are when you establish the fund initially, so debit to petty cash, credit to cash, or when you actually change the overall balance in that account. So in the first case here, we changed our overall balance from 75 to 100. So we needed to bump up by $25. So that's what we see. And in the second case, we moved from $75 down to $55. So we simply debit cash because we're putting the petty cash money back into general cash, and we credit petty cash. There is no other time where you will ever use the petty cash account. Only when you establish the fund and when you actually change the overall balance. When you reimburse the fund, the credit is simply to cash. So do keep that in mind. Now, just like we saw with a cash register or with a bank teller, your petty cash supervisor may actually be off at some point in time. So if the petty cashier fails to get a receipt for payment or overpays by a certain amount, cash over or short will, of course, result. So petty cash payments reports, plus cash left in the account will not actually equal to the fund balance. So this is where we're missing a receipt, for example. I bought something for $8. I didn't get a receipt for it. I was careless. I accidentally threw it away or lost it. Whatever the case is, I'm missing a receipt for $8. Well, when the end of the period comes around, I'm going to be off by $8. So we've got to deal with this. So if we have a shortage, the difference, of course, will be debited to cash over and short. And if we have an overage, of course, the difference will be simply credited to cash over and short. So we'll work through some examples of this actually in class. It's kind of hard to tell exactly what's happening in this example here unless you go through the section in the textbook with it. So if you want to do that, feel free to do so. But we will work plenty of cash over and short calculations in class, so I'm not going to dwell on it here, just for the sake of brevity and to try to make sure this video doesn't drag on too long. So now when we talk about banks, who are of course a large part of our internal controls and a large part of keeping our cash secure, we need to kind of understand what banks actually do for us. So of course banks give us things like signature cards and have bank accounts, print checks for us, and can run EFTs, but they also give us bank statements. So a lot of you may or may not really deal with your bank statement every month, but here's what you should be doing. Okay, at the end of every month, and certainly what every business is doing, I would imagine, is they will take the bank statement that they get from the bank. They will then look at that bank statement and they will compare it to their checkbook. They will then determine if the bank statement and their checkbook actually show the same balances. And I would be willing to bet you 99 times out of 100, they will be different. And we'll discuss that in just a little bit as to why your bank statement may not always match up with your checkbook register. So let's see. First thing, we're going to kind of run through all the topics they've listed there. Just very briefly, a deposit ticket. You've all seen this. Anytime you've gone to the bank, you get something like this. It shows what check you actually deposited, how much money, all that stuff. A check, of course, used to withdraw money from the bank. Here's an example of a check. So nothing unusual here, simply includes basic information, who you paid, how much, who signed off on the check, all that type of stuff. Bank statement is exactly the most important item that we're going to talk about in this section, as the bank statement provides a ton of useful information to us, and we'll see exactly how to pull information out of these bank statements and actually run through what is called a bank reconciliation, where we're able to identify any differences between our bank statement and our checkbook balance. Now, the next area is, of course, the preparation of this aforementioned bank statement. So here, of this bank reconciliation using our bank statement and our checkbook register. So in this case, what you need to know is there's a very simple rule that will help you prepare every bank reconciliation properly. The rule is this: Okay, if you only hear one thing in this section, remember this. A bank reconciliation asks the question, who does not know about the transaction? And that's it. If somebody does not know about the transaction, they must make an adjustment. Okay, so we've got the bank side and we've got the book side. The book side is us, the company. The bank is, of course, the bank. So here's what happens. When you go to the bank and you put money in the night deposit, does the company know that they have just made a deposit into their bank account? Certainly. If you drove over there and put money in the night deposit, then you know that the company has made that deposit. But if that is the last day of the period, will the bank know that that deposit has been made until the next business day? Of course not. Right? There's no way for the bank to know about a deposit you put in the night drop until they come in the next day and see it. So when the bank reconciliation is prepared, the bank statement will have cut at 11:59:59 that night. But that deposit has not yet hit your bank account. But the company did record that increase in their checkbook register. So the company's already good. They've already included this deposit. But when they get the bank statement will not show that deposit. So they're going to have to pencil in on the bank side this deposit in transit. This is the first adjustment that will have to be made. Now, do be very careful with night deposits. A few years ago, there was a case where somebody put a cardboard box out in front of one of the banks and it said night drop, and people actually fell for that and put large amounts of cash in the cardboard box. And then the guy walked up a couple hours later, picked up his box, and went home with a bunch of money. Of course, that money never did hit the bank statements because the money was not actually deposited. So if you are using a night drop, make sure you are using the actual night drop. It will typically have a flap on the side of the building. It'll raise it up. It'll have a chute that goes down inside the bank into a secure vault. That's what you're looking for when you're using a night drop. It's not going to be a cardboard box sitting outside. So do be aware of that. But that is what a deposit in transit is. It is where the company put the money in the bank, but the bank does not know about it yet. So the bank needs to make an adjustment. Now, on the other side, or in the next example, right, we're going to talk about your grandparents very quickly. So imagine it is your birthday and your grandmother or your grandfather writes you a check for, say, $10. They write you this $10 check. You collect it in the mail. But $10 may not necessarily be enough for you to be willing to get up right this second and drive across town and wait in line at the bank to deposit. So you think, well, all right, I'll take it to the bank, but I'll take it to the bank the next time I'm at the bank, right? So you say, that's fine. Well, it so happens your birthday is just a couple of days before the end of the month. So by the time you have waited to go to the bank, it is now the next month. Well, at the end of the month, your bank prints a bank statement, or your grandparents' bank prints a bank statement for them and sends it to them. Well, when they get their bank statement will not show the same balance as their checkbook, because when your grandparents wrote you that check, they immediately took that balance off of their checkbook and they showed minus $10 on their checkbook. But the bank has no idea that check has been written because the bank won't know about it until the check is cashed. So for the entire period of time that you maintain that check outside of cashing it at the bank, your grandparents' checkbook will be off by the amount of that check. At the time that you actually take that check into the bank and process it, your grandparents' account will now show the correct balance again. This is what is called an outstanding check. It is where the party who has written the check knows about the check. So they have already made the adjustment to their side. But the bank won't know about this until the check is cashed. So in this case, the book, right, will treat your grandmother or your grandfather as the book in this case. They don't need to make an adjustment. They've already done that. But the bank side will need to be adjusted to actually subtract the amount of that outstanding check. And of course, if the bank makes a mistake, you will add or subtract as needed on the bank side. So the rule with errors is just whoever makes a mistake, that is the side that has to fix it. Now, on the other side, we look at our book adjustments. So what does the bank do that the company doesn't know about until they receive that bank statement? Now, to be fair, this is less accurate in today's world where we've got electronic banking, where we've got the ability to log into our bank account and check it 86 times a day if you want to. So in this class, we pretend as if electronic banking is not a thing and nobody ever learns anything from the bank until they get the bank statement. It really simplifies things for us. So that's how we're going to approach this. Okay, so I don't want you to think, well, they could have checked their account. Of course they're going to check their account. Of course companies are always checking their accounts. They're not just going to wait till the end of the month to check it. But for the sake of this course, that is the approach we're going to take. So first thing is, if you had any cash in the bank that earned some amount of interest, you will get that credited to your account. The bank will increase your balance by that amount as soon as it is earned by you. Now, the bank knew about that. They already made the adjustment. They don't need to make another adjustment. But you do need to make an adjustment because you had no idea that you had earned interest until you saw the bank statement. And you said, oh, well, great, I've got that new interest. On the other hand, you could also have a company that does not actually collect cash themselves. They tell customers, if you want to pay me with cash, you do not bring it to me. You take it to my bank and tell them you want to put it in my account for payment of this bill. What this does is this relies on the bank's system of internal controls rather than your own. So if you don't think you have the resources necessary to actually implement a good system of internal controls, you can outsource that essentially to the bank and rely on the bank's system of internal controls so that your customers actually go take the money directly to the bank. That way it saves you a trip having to drive across town, and it also prevents any of your employees or anyone coming into your business from taking the money from your business. So if you have any interest earned, that'll be dealt with, and that will of course increase the bank balance. The book balance. And of course, any unrecorded cash receipts will also increase the book balance. Now, the things that are going to subtract from your book balance are things like bank fees. Maybe you had to have more checks printed, so they charged you a fee. Maybe you had less money than you agreed to have, so they charged you a low balance fee. Maybe you had an NSF check, a non-sufficient funds check, a customer's check bounced, so they charge you, right? All kinds of charges you may be getting hit with from the bank, and those of course are known by the bank because they're the one levying the charge. So they don't need to make an adjustment, but the company of course does need to make an adjustment and will reduce their balance for those amounts. And of course, if the company makes a mistake, we'll have to deal with that on the company or the book side. Okay. Now, here's our general format. Okay, the balance of a checking account reported on the bank statement will typically not equal the balance in the depositor's records. So what we're going to have to do is figure out some way to set this up where we can very easily organize our thoughts and our information and then figure out if at the end we actually do reconcile. Because what we should find is that the cash balance per the bank, once it has been adjusted, should equal the cash balance per the book once it has been adjusted. But at the beginning of this process, it is very likely your cash balance per bank will not equal the cash balance per book. Now, at the end of this, we will need to record some journal entries, of course, right? So don't think we're going to get away from this chapter without a few more journal entries. So, but we will only be recording those, notice, for the book side. We work for the company, we don't work for the bank. The bank has its own accountants and they can record their own journal entries. We're not going to be doing those in this course. So if I ask you to record the journal entries necessary for a bank reconciliation, only prepare the journal entries for the book side. Okay. Now, here's how this works. At the beginning of this, we had a bank statement balance appears to be $2,050 and a book balance of $1,405. Do these two numbers equal? No, they do not. And you say, well, why don't they equal? Shouldn't they equal? And the answer is yes, they should, but not necessarily now, right? Once we get done making all of our adjustments, our adjusted balance will be the same as long as everything has been done properly. If we do a proper bank reconciliation and this does not balance, then it means one of the two parties did make an error that has not yet been discovered, and we need to go find that error. But if we've done everything properly, then we should be able to tell at the end that the adjusted bank balance is equal to the adjusted book balance. This is one of my favorite questions when I was a student because it was one that I knew for sure if I got right before I left an exam. if I had to prepare a full bank reconciliation, then I could guarantee myself before I left the room, whether I got 100% on the other questions, I may not know for sure. But if my adjusted bank balance equaled my adjusted book balance, there was about a 98 to 99% chance that I got 100% of those points right. Because barring some bizarre situation where something can be flipped right and it somehow works out, it's very difficult to get this to balance if you make a mistake in your actual bank rec. So when those two numbers balance, you should feel pretty good that you probably got everything correct. So we do this with a 4-step process. So of course, the first thing we're going to do is deal with actually pulling down our original balances. So jot down whatever they tell you. You'll then have to read through the facts of the information. Of course, we'll do this several times in class. So we'll see this worked out quite a bit. We'll probably work several examples of this. But you'll add anything that needs to be added to the bank side. Primarily, what you will typically see over here are any in-transit deposits. So this is something that was put in the night drop, perhaps. So we know about it. The company knows about it. But the bank won't know about it until November 1st when they come in and actually begin work. So this has not been included in this $2,050. So we'll have to add that $145 back. Now, on our side, the bank collected a note for us of $485, and we earned $8 in interest. So that gives us an extra $493. $493 plus $1,405 is $1,898, and $2,050 plus $145 is $2,195. Notice at this point, we still don't balance. That's fine. We shouldn't necessarily balance here. Could you? Perhaps, right? If the numbers just happen to work out like that, sure. But most likely, you will not balance here, so don't get too caught up with that. Next, we've got to deal with any outstanding items. So on the bank side, we have written 2 checks, 124 and 126, that have not yet cleared. They totaled out to $350. That brings our adjusted bank balance down to $1,845. So once these 2 checks come out, we'll be left with this $1,845. Now on our side, on the book side, we've got our check printing charge. So they charged us $23 to print more checks for us. And it looks like we had a bounce check. So maybe a customer tried to pay us and it came back negative. So that was an NSF check. It's non-sufficient funds, $30. Gives us a new amount of $53. It needs to come out on our side. $1,898 minus 53 is $1,845. And we're able to see very clearly then that our $1,845 does in fact match on both sides. So very important there. Now, the next thing that you want to do is actually prepare those journal entries. So here we're going to only look at the book adjustments. Remember, the bank makes their own journal entries. I don't work for the bank. You don't work for the bank. Okay, unless you actually have a job for a bank, and then you'll need to learn their side. But here, we're simply working for the book. So for each of these adjustments that we made, the note, the interest, the check printing, and the NSF, we will need to make a journal entry. So with the note, what happened? Well, we collected cash. So if we have received cash, cash must go up. Cash goes up with a debit, so we simply debit cash. And they told us that was a note that was collected, so we'll simply credit notes receivable, reducing that balance. So you paid me $485, you now owe me less money. Easy enough. With the interest earned, right? We debit cash, we simply credit interest revenue. We got cash, and it was because of interest. So that one's pretty straightforward. With check printing, okay, if you're taking a paper exam for me and you give me something like check printing expense, I will accept that. I won't count it wrong. You'll get credit. That's fine. If you're taking the exam on McGraw-Hill, I don't think it gives you an option for that account. So you'll have to go with miscellaneous expenses, and that would be the correct account for McGraw-Hill. So debit to miscellaneous expenses, credit to cash. You had to pay it somehow, so it comes out of cash. Now, here's the deal. With the NSF check, you've really got to understand what has happened. A customer wrote us a check, but that check didn't clear. They didn't have enough money in their account to actually write that check. So they wrote us a $30 check in good faith, perhaps, but the check didn't clear. So what happened was when they wrote me that check, I, assuming they were writing me a good check, debited cash and credited accounts receivable, indicating that they did not owe me cash anymore. But when that check bounces, I must reverse that entry because even though they tried to pay me, they weren't successful. So I have to reinstate that accounts receivable with a debit. So a debit to accounts receivable and then the customer's name, and then a credit to cash. Because I'd already added the cash into my account, well, now I've got to credit that amount. Now, last couple of things here. We want to compute days sales uncollected. So here we go. In this case, we're looking at days sales uncollected. And remember our rule. Anytime you see the word days, you're going to multiply by 365. So don't forget that as we come up to it here in a moment. And the general formula here, of course, just simply accounts receivable over net sales. So in this case, we've got the information for Starbucks and Jack in the Box. And it looks like for Starbucks, they were at about 13.7 days of sales that were uncollected 2 years ago, down to 13.2 and back up to 14. So pretty stable between 13 and 14 days, but getting slightly worse, right? So their sales are sitting out a little bit longer than they had been. Now, with Jack in the Box, it looks like 2 years ago we were pretty speedy at about 11 days, but now we're settling in somewhere around 16 in the last year or so. So a little bit more concerning here. That's a pretty big jump. So it looks like they've got a huge swell in accounts receivable, and we see that from 48 to 73 with only a moderate jump in sales. So for whatever reason, they're selling a lot more on account, about 50% more in that case from 2 years ago all the way up to 1 year ago. But they're not seeing that large of an increase in their sales. So it's leading to this very large increase in days sales uncollected. This may be something they're okay with, but truthfully, it is a little concerning because it is dramatically slowing down the speed at which they are collecting their money. So you do want to be aware of that. And with that, that of course wraps up the end of chapter 6. We won't cover the appendix. So with that, if you have any questions, feel free to reach out to me. I'd be happy to meet with you and help you in any way I can. Otherwise, y'all have a great day, and we'll see you in class. Thank you.